are two things at play here. One is, if you look at the valuation of Apple, it's comfortably at a 5-year high on all relative metrics. If you look at the last 5 years, which has sort of been the post-hypergrowth period for Apple, it trades at 0.8 times the market multiple. Right now it's trading at 1.05 times a market multiple. So it's 25% more expensive than it has been on average. And that's pretty similar whether you look at it on a cash flow basis or on an earnings basis relative to the market. So they're doing good things, but the stock's being rewarded for that. And I think one needs to be careful more careful when valuations are at elevated levels.
That's a fair statement. The stock has already had multiple expansion. If you were to, let's say, downgrade it today from a buy to a market perform for all the reasons you've just said, I'd say, okay, that's fair. Multiple expansion, getting a little high in the air, but we're not talking about a move that was made today. All of the move from then until now, it seems you've missed.
Yeah, and look, I mean, I'm not gonna suggest that I haven't. I think your assessment that we've been a chaser has been correct, and again, I think that's kudos to strong performance from Apple. I think it's also a reflection of kind of how investors are looking at the marketplace. I think the second thing that we have been anxious about and are still not 100% out of the woods on, Scott, is the strength of this iPhone cycle. And you may say, well, does iPhone really matter? And I think it's important to rewind to a year ago where the stock was on a relative basis at similar levels. On a relative basis, Apple hasn't outperformed over the last 12 months. It's perfectly in line with the market. So a year ago, Apple was faring really well, and the rhetoric there was services are doing great, iPhone doesn't matter as much. And what happened? We had a weak iPhone cycle, and the stock was punished. And at least for me, I don't think we're out of the woods that we know that this might not be a weak cycle. And the reason why there's more risk in this cycle for Apple is, unlike previous years where average selling prices were going up, this year average selling prices will be down 5 to 10%. So even if your units are kind of okay, your iPhone revenue could be down 5 to 10%, which is well below where the street is at. And so we've been looking for one of two things. One, confirmation that this cycle will be strong, and I don't think anyone knows that at this point, but we do worry about the ASP headwind, or looking for a valuation break, and we haven't gotten either, and maybe we'll be wrong on the cycle, in which case, we've been a chaser, and shame on us for missing it.